Welcome to Bloomberg Markets. I'm Scarlett Fu. A record rally, big bank earnings helped lift the S&P 500 to a new high. So here is where things stand right now. As I mentioned, S&P 500, highest level ever, at least for now. If it closes at this level, I believe it'll be the 45th record close this year, 5807 for that index. The Nasdaq 100 gaining about 0.1%, but we should mention that within the S&P 500, it is the big banks leading the way up. And the 10-year yield moving up just slightly to 4.07%. At one point, it did rise to as high as 4.11%, holding above its 100-day moving average. We had a hotter than expected consumer inflation report earlier this week, and the latest wholesale data showed prices were basically unchanged, at least compared to a month ago. And oil prices taking a bit of a breather after yesterday topping $76 a barrel. Traders remain on edge. They're anticipating Israel's expected retaliation against Iran, but we're also awaiting more Chinese stimulus. The finance minister of China will be holding a briefing tomorrow, and later on this hour, we've got a preview on what to expect from that. Let's go back to equities for a moment here and check out some midday movers and bring in Bloomberg senior equities reporter Jess Menton for more. Jess?
Looking at the worst performer in the S&P 500 today, it's actually Tesla on the back of that robo-taxi event from Elon Musk late last night. So unfortunately, this underwhelmed investors. We're looking for more details here. So if you look on the opposite side of that, though, Uber is actually the best performer in the S&P 500 today, because Truist was talking about how because there was a lack of details, it won't really hurt the competition if you're looking at Uber or even Lyft. So both of those stocks higher here. Uber on pace for its best day in about 2 months, whereas Tesla's on pace for its worst day in about a month, though. If you look overseas, though, as far as what's happening, it's European automakers that were lower today. Unfortunately, Polestar, when it came to its deliveries in the latest quarter, underwhelming investors here. Also, its new CEO is thinking about potentially having more cars being sold at deliveries and dealerships here instead of just online. Also, if you look at other stocks, Stellantis, for example, had a big shakeup when it comes to executives. Its CEO is expected to retire in 2026. It just ousted its CFO, so that's why you're seeing that stock almost 3% lower here. Of course, Volvo is going to have earnings next week. Bloomberg intelligence analysts think that potentially the new builds might come in lower than expected. And unfortunately, Volkswagen just got a downgrade from Moody's to negative. They're not optimistic about the outlook when it comes to those European automakers. You look at that stock down about 1%, but coming off of those lows from earlier. Of course, we had a ton of different bank earnings this morning. Of course, JPMorgan's net interest income came in stronger than expected. You're looking at that stock up about 6%. Of course, Wells Fargo also moving higher here, as when you're looking at that, and JPMorgan also up close to about 5% here. But Wells Fargo is, especially when you're thinking about some of the metrics it was beating on, coming in stronger than expected. Of course, BlackRock, when it came to those flows, coming in at records here on the net basis, as well as New York Bank Mellon. It did beat on some of the top lines, though that stock's still down about 1.5%. Of course, we're going to have more banks coming up next week, Scarlett, with JPMorgan. And also, when you're thinking about Goldman Sachs coming out next week, also Citi, of course, Morgan Stanley as well.
All right, good stuff. Thank you so much, Jess Menton, with a recap of our midday movers. Now, if you take a step back in the lead up to, and of course, since the Fed's decision to cut interest rates, markets have been more optimistic than not. Still, there is a degree of caution on Wall Street as the U.S. election looms and geopolitical tensions flare. So, should markets be more concerned that we're on the verge of a so-called black swan event? The original author of that phrase, Nassim Taleb, is here with Bloomberg's Sonali Basak for a special interview. Sonali?
Scarlett, thank you so very much. Of course, yes, I am sitting by with Nassim Taleb here. And it's interesting. Good to see you here. You know, a couple weeks ago, we spoke to your colleague, Mark Spitznagel, who is over at Universa. He had been bullish on the market, but has been voicing more concerns.
Yes.
How do you feel about where we stand right now?
So let me qualify by saying that Universa is market blind, formally market blind, but we're humans. We have opinions about the world. And the whole idea, the Mark's sentiment was that you need a big tail hedge and you need a big position. It compensates you because the market rally, allows you to have a larger position. If a tail hedge allows you to have a larger position, so that was his position. But now we have a lot of risks building up. Okay, whether the first one I think is, of course, we're starting to pay for debt, and year after year taking a larger portion of the budget. So it's not out of control yet. Europe is worse than us. When you have debt, you need to grow very fast. We're growing, but we should grow faster to be able to control that debt. That's a big thing. The second one is, and I'm really worried, if someone asks me what are the top two biggest financial mistakes made in the 21st century, one of them would be confiscation of assets by, after the Ukraine war, of people, because this kind of thing you can do once. So the United States bullied Europe to participate in confiscation of assets of all, some of relevant people, with vague links to the Russian regime. And it may make sense maybe from a justice standpoint, but you've got to remember that it's not going to encourage people to invest in the system, okay? So transactions are still conducted in US dollars, but we're seeing more and more the storage in gold, and you see it in oil prices, whether the central banks and individuals, okay? People want out of that system. So I'm really afraid of a progressive loss of the role of the dollar in in the global transactions.
It's interesting. The dollar fear has been a very real one for many investors, but you've seen dollar kind of supremacy still reign.
I think it reigns transaction-wise, but people conduct nominally a transaction in dollars, you exchange dollars, but they don't store it in dollars. And that is what the problem is.
It's interesting. You mentioned oil for just a moment there. With all the geopolitical risk we're seeing, particularly in the Middle East, you've seen Brent rise above $80. And where do you think it goes from here?
No, it's pricing in a small probability of a big, I would say, geopolitical event. Small probability. Not very high, because should that event happen, oil would be way, way above 80, as you can expect. We'd have a worse than 1973 oil crisis, because we have a more fragile, more interactive systems than 1973. So, but I think the market's pricing in justifiably a small probability of that. People are aware of that possibility, but they're not putting too much trust in such a forecast.
So you mentioned gold for a minute here. How much are you willing to be buying gold at this moment too? And do you buy it as a kind of answer to your concerns about the dollar?
I'm not a gold buyer. I would say that I'm more of a my focus would be more on being hedged against a eventual market collapse, because we're more fragile than we were probably at any point in the last 20 years. So if not, 30 years, we're very fragile. And also, you've got to realize that the big rally in the S&P 500 over the past 12 months is attributable to a very small number of firms linked to AI. Now, AI is probably going to be the best investment, but maybe not in these firms. In other words, they may not be representative of the growth of AI, because remember, when the internet started, everybody used Alta Vista. They were one of the pioneers, and then we switched to Google. Okay, so in other words, some existing firms have a huge capitalization, gains in trillions, owing to the promise of AI, and someone else may come in and take the business away from them.
Yeah, you've navigated some of the most significant market moments in history, Black Monday, 2008. Yes. How do you see this moment? You talked about fragility in the market today. The market has shrugged off almost everything this year.
What happened is like these crises happen when you expect them the least, which is why people don't have any protection. They're overexposed to the market. And I think it's very similar to the environment we had in previous collapses. And the market becomes complacent. People are used to it. They may have some kind of precaution in the beginning, but then they throw precaution to the wind. You get more rally, and that's when vulnerability is going to be at its maximum.
What are the words that you would use at this juncture? Are we in a bubble? Is there still animal spirits jumping around? And what is causing it? What is causing the exuberance we're seeing in the market today?
I think that we are coming out of an environment of very low interest rates that taught people to avoid conservative investments and go into assets that can gain in value. So people are used to investing in the market, used to like investing in the market. And that was, I think, Mark Spitznagel's point, is that it's attracting more and more people and has more, the reasons they got in, you know, are there, okay? So nothing has changed. But all you need is just a small change in perspective, you see, to expose the fragility of it. We have valuations that are crazy, built on a lot of hope, and the economy is very confusing, you see. So on what you hear stories here and stories there. Okay, is it overheating here, or is it cooling off there? You see, so we don't have a classical environment for us to make judgments. So which is why I would say that one has to be schizophrenic, extremely bullish, while believing in a total collapse. In other words, tail risk hedging. Okay, that's Mark's point. Although I think Mark, as you said, is less bullish than he was, or maybe he's even waiting for the first shoe to drop.
Well, how does this time compare to other times in history? Another thing Mark mentioned is that we're really vulnerable to black swan events. I thought that was an interesting comment because as long as I've known you, you've been very reticent to call out black swan events.
No, but we have a fragile system, okay, and we have more interdependence, and it was shown during COVID, between world economies. We have more globalization, almost, you know, at its peak, so more dependence between economies. So in other words, if something collapses, it causes feedback loops. We have more debt in the Western world relative to, particularly debt relative to growth, than we can handle. And what's bad here is that, and it's sad is that, you know, as you get richer, typically, you start having more debt, but your incentive to grow isn't there anymore. So we are now probably the richest we've ever been, and we've never had more debt. And it makes no sense because you have to grow out of this.
To that end, on the debt market, do you think that the U.S. is going to be able to continue to issue in the way that it has? Will there be foreigners to buy U.S. debt?
That's exactly why I'm afraid. I'm afraid of what the current administration has done in 2022 when they confiscated assets. It doesn't encourage people to invest in new currency because the first geopolitical problem, and you may be, if you're, let's say that you're a citizen of countries that are, you know, in the Middle East or in Asia or you know, or even in Eastern Europe. You don't want to be, you don't want your money taken away from you. You see, once you do it once, you can do it once. It's not the kind of thing that you can do twice. So that is harming the dollar and harming the United States enormously. And I think President Trump mentioned that. He said we shouldn't be freezing assets.
Nassim, we do have to leave it there, unfortunately. We are running out of time. Scarlett, of course, that is Universa Investments Distinguished Scientific Advisor, Nassim Taleb.
Thank you so much, Shanali. We have a lot more to cover, and you guys mentioned banks. Let's talk about banks. JPMorgan and Wells Fargo reporting their results. Those shares are higher right now. We've got details ahead. This is Bloomberg. This is Bloomberg Markets. I'm Scarlett Fu. It's time now for the stock of the hour. And with investors digesting the start of bank earnings season, we're going to kick things off with JPMorgan. Its shares jumping after the firm reported a surprise gain in net interest income last quarter and raised its NII forecast for this quarter. However, CEO Jamie Dimon tempered the outlook for next year.
NII, all things being equal, is a number, but all things are never equal. I think we spend too much time on just this irrelevancy, so you get a model and a number in your model. And So it's going to be less than 87 next year. Probably not a lot. We don't know, and we don't know the environment.
A beat and raise on net interest income for the third quarter and fourth quarter, but the outlook for 2025, according to Jamie Dimon, is a little bit rosier than what, or I should say, analysts are a little bit more rosier than what is likely to happen. So my question to you is, does this set the bar or the standard for what other banks need to deliver this earnings season?
I think it does to some extent. I think we're positively encouraged by the beat and raise. I think broadly speaking, we do expect moving into a rate cut environment should help banks broadly on the deposit funding cost, deposit beta slowing, deposit competition fading to some degree. So I think that is the expectation broadly, although I think the stocks can still work in lower expenses and better credit as well.
Well, Jamie Dimon sounded a cautious note about the overall environment, and this is backed up by the firm's provisions for loan losses coming in higher than expected and a net reserve build of $1 billion, mainly from card services. Are you comfortable with the picture that this paints of the U.S. economy? Is this consistent with a soft landing?
I think it is consistent with a soft landing. We have been looking for credit normalization for several quarters now, and particularly on the consumer side. I think what we're encouraged by is a couple things. Number one, the guidance on card losses looks like it'll be on sort of the lower end of that when we fully phase in full year 2024, but also looking at some data points like the credit card master trusts, which have shown that second derivative has been slowing for the last 5 months. So healthy normalization, some seasoning going on, but not necessarily stress. We're a little concerned about the lower end, but overall, we think the consumer is healthy.
And just one question to you on Wells Fargo as well, because lower rates should mean a pickup in the mortgage business. Is this all business that Wells Fargo can't really capitalize on because of the asset cap that the Fed has imposed on it?
I think Wells is in a little bit different situation than some of the other banks, clearly because of the asset cap. But we did see strength in the fee income line. And a lot of the mortgage product it tends to be agency product, which is sold off to Fannie Freddie. So that, I think, does put them in an okay position to capitalize on a refi boom as rates come down as well.
Cheryl, really appreciate your joining us. Cheryl Pate of Angel Oak Capital. All right, let's transition to China right now, because a Bloomberg survey shows investors and analysts expect the country to announce up to 2 trillion yuan, that's about $283 billion, in fresh fiscal stimulus tomorrow. The finance minister is set to outline those plans that could include consumption vouchers, subsidies for goods, family support, and more. But is it enough? For more on this, let's bring in Bloomberg's Enda Curran, who covers global economies, and he joins us now from Washington. Enda, this briefing is coming on a Saturday, but earlier in the week, another government unit, I believe it was the State Economic Planner, disappointed the market with its unveiling of additional spending. Why are investors counting on this coming briefing on Saturday to make a difference?
I think because government spending has been the missing part of the jigsaw so far in this whole stimulus narrative over the past few weeks. Scarlett, the expectation tomorrow is that when the finance ministry takes the podium, they will have a material announcement. It's expected to be about putting money into the economy now. The question is it going to be new money, or will they merely be accelerating using up this year's budget? For example, a lot of economists make the point that spending for this year is actually behind schedule. So what they could do is just speed up where they are and get that money out the door, which isn't necessarily new money per se, or not necessarily major stimulus. They might signal that they're going to bring forward some spending commitments into 2025 and, signal that they're willing to dig deeper into the deficit as they go forward. So question marks over the technicals of what constitutes new money there. And then the second part of it will be, where will the signal that money is going to go in the first instance? We don't have much by way of detail on that, but the expectation is they want to do something to get people spending again and maybe get some big projects finished as well.
How much feedback from investors, from the business and finance community, maybe even consumers, is the government likely taking into account with its current, I can only describe it as like a drip approach to announcing these measures?
It has been piecemeal, it has been confusing, especially given that you can see the reaction in markets. But I think, though, writ large, the response among analysts has been that this is a change of tone from the authorities. There is now a sense of urgency that they need to tackle deflation, that they need to get the consumer spending again. Remember, the rest of the world has been looking towards China for some time now, since post-COVID, wondering, well, when will they get motoring? So there's a sense now that the authorities are responding to what's happening in the market and on the ground. The question, though, is just how much money will they be willing to put on the table? And that's the big unknown tomorrow. As you say, the expectations for that are quite broad. I think, broadly speaking, authorities are maybe less concerned about what's happening in the markets, but they are concerned about what's happening in people's living standards.
Absolutely, and whether they can get confidence back up among consumers. And always appreciate your joining us, Bloomberg News reporter Enda Curran, who covers global economies. I'm Scarlett Fu, and that does it for Bloomberg Markets. Balance of Power is up next.